All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is July 16th, 2025. And the top story this morning, I really wish it wasn't the top story, but I am shaking my head this morning because I can't believe what I read in the Wall Street Journal yesterday afternoon. President Trump is preparing to sign an executive order opening up 401ks to private assets. Ah, yes, that big move from Washington, D.C. that nobody wants. Literally nobody is asking for this. No, wait, I'm wrong. Some people are asking for this. Some people are screaming, begging for this. And it's the people who desperately want to get rid of this garbage, not the people who want to buy it. Nobody wants this. Why are you doing this, President Trump? I'll tell you why you're doing it. It's a bailout of Wall Street. That is what this is, this executive order to democratize access, to improve access, so to bring these investment opportunities to the everyday person. My old boss in nuclear, he always used to put on his Bill Lumbergh face every time there was a job that he knew was like a BS job and nobody wanted it and it was going to go to me or something like that. And he'd always say, Jack, we have an exciting opportunity for you. He did it on purpose, sarcastic, like, Jack, I'm screwing you over to your face and I'm making a joke about it. But yeah, when somebody describes something as an opportunity, it's because it's not. They're giving you a bag of crap to hold. Private assets, private equity, private credit, debt to companies that don't have any cash flow, things that are notoriously mismarked, as in they're not worth what people say they are. Things that for years, private equity funds have been tap dancing and tiptoeing and creating secondary offerings and net asset value financing and all these cockamamie acronyms to avoid selling this stuff to find out what it's really worth. Now all that crap is going to be dumped into 401ks, and they're not warning people about this. Now, look, any given day, I'd be like, channeling the libertarian in me, hey, let people make up their own minds. And if they want to do this, go ahead. That's fine. But this is not any given day. This is a day where this crap is all about to blow up and implode. And they're like, real quick, let's park this on the balance sheets of freaking poor people before my buddies in Wall Street take the hit. And yeah, I'm pretty irate about it. I've been warning about this for months. I did a whole big expose on this on my buddy Travis's channel over at Real Estate Mindset. Shout out to my buddy Travis. Nobody wants this except the people who are selling it. Oh, and by the way, this is a bailout of Wall Street using grandma as a human shield, because nobody's going to want to bail out Blackstone when private equity blows up, when private credit blows up. Nobody's going to want to bail out Brookfield Asset Management. But if Blackstone and Brookfield and Coatue and all these firms are able to dump this garbage into your 401k, everybody will want the bailout if the 401ks fail. Oh, then we just need to guarantee the retirements of hardworking people. Are you kidding? That crap will sail right through Congress without even stopping. It's just another bailout. You know who else this is a bailout of? Those colleges that President Trump is saying he hates so much. Harvard, Yale, all these big hedge funds with a college attached that President Trump has been so critical of lately because of anti-Semitic protests on campus and all the other reasons. They're basically just churning out good little woke automatons instead of preparing people for the economy. Well, you know who was some of the biggest holders of these private assets who are being forced to sell and there's nobody to sell them to? That's right. It's those college endowments. So it's also a bailout of freaking colleges. And the reason these colleges need a bailout is because what President Trump is targeting them. It's a little counterproductive, if you ask me. So yeah, I'm pretty irate about this. We're going to read all about this article that came out in the Wall Street Journal yesterday. Also going on this morning, PPI came in actually below expectations, quite a bit below expectations. Headline PPI was 2.3% year over year, 0.0% month over month. But it was core PPI that came down sharply. And actually, core PPI month over month was nothing. I'm really surprised to see that, especially because we started to see the tariffs showing up a little bit in consumer prices yesterday with that rise in CPI. But now we're seeing the opposite in PPI. So that's a little interesting. I mean, if CPI going up, consumer prices going up, but producer prices going up slower, that would suggest profit margins getting bigger. I don't really think that's what's happening, though, across the economy. So I'm scratching my head at these data points a little bit this morning in the PPI index. We also got bank earnings this morning. Now, this is interesting with banks. We saw a pretty widespread sell-off in bank stocks yesterday we had JP Morgan and Wells Fargo. Both came out, and they showed a little bit of a decline, some disappointing, not a decline, I should say. I say a disappointing report in net interest income, the difference between what they're paying out in interest to their depositors versus what they're collecting in their interest from loans. My friend Coastal Journal was pointing out that the short-term borrowings at Wells Fargo were slightly elevated. Short-term borrowings could be anything from repo markets to Federal Home Loan Bank advances or brokered deposits if it's an emergency. Typically, banks pay a little bit higher interest for short-term borrowings. So that could be the reason for that compression in net interest income that the bank saw yesterday. And that probably was the reason for the sell-off in bank stocks. Now, it hasn't reached like bank run fever pitch levels, nowhere near that level, but it is an early indicator of some stress building up there, something to worry about, or something to at least keep an eye on. I wouldn't say you need to be worried yet. Now, the bank earnings we got this morning, a little different. We got Bank of America came out. Their net interest income actually rose 7.1%. Pretty good numbers from Bank of America this morning. We also got fantastic numbers from Morgan Stanley and Goldman Sachs. Those are the investment bankers. They're doing great, especially because they get a lot of revenue from trading. And of course, everybody was trading last quarter with the sell-off and the tariffs, and then they bought it all back after the taco trade. So I'm not surprised to see those numbers this morning. Also going on, we've got Dutch chip making equipment supplier. They make the equipment that makes the chips. This company, ASML, they are down big this morning. They just warned that they can't guarantee any growth in 2026. It looks like this is a tariff story. I'm guessing this is a tariff story, possibly an indicator of a little bit of slowing in the enthusiasm for the AI mania as well. Also, speaking of European companies and profit warnings, yesterday, French automaker Renault got clobbered after a profit warning, down big double digits. And now that company has said they are going to focus on value versus volume. And wow, that sounds great. Value over volume. Hey, I'm sure that polled very well in focus groups until you realize what it means. It means we're not going to bother trying to make cars for poor people. We're only going to make a few cars. They're going to be really expensive. So Klaus and his friends in the WEF, they can still drive cars while asking each other for Grey Poupon at stoplights and then looking down at the plebes and telling them you can eat bugs and ride to work on high-speed electric roller skates because they're not going to make affordable cars. What is it with the auto industry that they just refuse to make cars people can afford? It's not that there's no money to be made there. It's just they won't do it for whatever reason. The first one who does it is going to make a lot of money, but it ain't going to be Renault. And last but not least, we got Westinghouse came out yesterday. There was this little gaggle of AI entrepreneurs and power companies in Pennsylvania with President Trump announcing all these wonderful investments in AI infrastructure in the United States to create these jobs. And the one that stood out was Westinghouse, who claimed they are going to build 10 of their modern AP1000 reactors starting in 2030. That's interesting because Westinghouse just built 2 reactors and it bankrupted them. So how are they going to build 10 now? Oh, they say because AI. Look, I love nuclear power. I hope we build more nuclear reactors. Personally, I would rather see us build small modular reactors instead of these big 1,000-megawatt pigs. But hey, I like the big reactors too. But the problem is we don't know how to build things in this country anymore. We need to change our regulatory environment. We need to stop giving the Gretas of the world such ridiculous power to stop multi-billion-dollar projects just because they lawyered up. I don't know how we're going to accomplish that, but AI sure as heck ain't going to do it. You know, oh, don't worry. We signed a memorandum of understanding with Google to use their chatbot, and that's going to magically help us overcome the fact that our last 2 reactors were $18 billion over budget. I don't know how they're going to pull this off, but I wish them luck. We got a lot going on this morning, guys. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance this morning. And hey, don't forget that like button and that subscribe button if you're new here, because we do this every morning. So come on and have your coffee with the melon heads as we go through markets. Right now, markets are up about 13 points for the S&P 500, 0.2% higher. Most of that coming in the few minutes following that PPI report at 8:30 a.m. Eastern time. The market liked those PPI numbers. The Dow is also up about 1/3 of 140 points in the green this morning for the Dow. And the NASDAQ is just barely positive here, 17 points or 0.07 points to the upside for the NASDAQ. Meanwhile, the dollar is higher once again, 98.7. We've had a couple days in a row of strengthening in the dollar. That's been putting some downward pressure on gold and silver prices here, continuing this morning, but still below 99. And looking over at the bond market, we got yields are a little bit lower after rising most of the day yesterday. The 30-year Treasury is at 4.99, back below 5%, although that's down about almost not quite 3 basis points this morning. The 10-year yield is at 4.466. That's lower by 2.5 points. The 2 years at 3.932, lower by almost 3 points. And the 1 month is down a fraction of a point at 4.309. Looking over at the commodities board, we've got a little bit of green this morning. Spot gold is up by $9.34, a little more than 1/4% higher. $3,334 for spot gold after a rough couple of days. Spot silver is finally catching a bid. It's sold off almost $2 over the last couple of days, sitting here at $37.86. That's up by about 17 cents or 0.5% this morning. I like the shiny. By the way, I got Bob Coleman coming on the channel later today to talk about gold and silver and possibly platinum as well. Look for that one this afternoon. I may end up running that tomorrow, depending on my editing schedule. And let's see, we've got copper is lower by about 1% this morning. Platinum is up by about 0.8%. Palladium is higher by 1.5%. And crude oil is actually down about 1.3%, $65.68 for August WTI futures. Now, let's talk about Bitcoin. It is back at 118,750. We saw Bitcoin sell off pretty hard yesterday. We talked about that whale that was dumping some, well, I think the number was as high as like 20,000 Bitcoin he may have been selling, or he was moving around. You know, the estimates varied, but one of the original Bitcoin miners, the guy was sitting on like a $9 billion stack of Bitcoin. He started moving his coins and selling them yesterday. That torpedoed Bitcoin price. Took us from a high of 123,000 down to around 115,000. Now we're back up at 118. We got a couple of articles about Bitcoin this morning. First, Bitcoin ETF inflows show institutions doubled down on Bitcoin at 116,000. That whale may have been selling yesterday, but Wall Street was buying. Bitcoin was a clear buy for institutions as Bitcoin price action briefly dipped below 116,000 on Tuesday. Data from on-chain analytics firm Glassnode revealed that while Bitcoin retraced its latest gains, large volume investors rushed in. Bitcoin's institutional investors are changing the way they react to snap Bitcoin price moves. As Glassnode shows, inflows into the U.S. spot Bitcoin ETFs remain high this week, even after the price dropped over $7,000. Monday saw one of the largest daily inflows to U.S. spot Bitcoin ETFs in the past 3 months, it told ex-followers in a post on Wednesday. But what stands out is Tuesday's response. Institutions didn't flinch. They doubled down, adding another 3,400 Bitcoin. Outflows remained near zero across the board. So people were buying the dip yesterday. Such behavior stands out versus earlier in 2025 and last year when sudden price corrections spawned instant ETF outflows. So sign of increasing appetite from institutions yesterday. Remember, those institutions, they're not allowed to hold Bitcoin because of their rules, but they are allowed to hold ETFs, even if those ETFs are holding Bitcoin. So when you see big inflows, it could be a sign of institutions buying. And we also got this one. Bitcoin price rises after crypto bill setback, but what Trump says will happen today. This one is updated this morning, came out yesterday. Bitcoin price and other cryptocurrencies were recovering early Wednesday following a setback to key crypto legislation on Tuesday. It had plunged a 24-hour low of $115,967 shortly after a procedural vote on 3 crypto bills in the House of Representatives was voted down on Tuesday afternoon. However, the price of the world's largest crypto began to recover after President Trump said some of the legislation lawmakers were set to consider during so-called Crypto Week could be passed as soon as Wednesday. Tuesday night, Trump said he had met with lawmakers and suggested the bills would be passed Wednesday morning. I am in the Oval Office with 11 of the 12 congressmen and women necessary to pass the Genius Act. And after a short discussion, they have all agreed to vote tomorrow morning in favor of the rule, Trump wrote on social media platform Truth Social. So it looks like that setback in the House yesterday, at least if President Trump is to be believed, that is now behind them and those bills are expected to pass today. All right. Now on to this one. Trump executive order to help open up 401ks to private markets. U.S. defined contribution plans held $12.4 trillion in assets at the end of 2024. And you better believe Blackstone and all those other private equity firms, they are just licking their chops, wanting to get a piece of your 401k, especially to dump the assets that they don't want onto your books. President Trump is expected to sign an executive order in the coming days designed to help make private market investments more available to U.S. retirement plans, according to people familiar with the matter. The order would instruct the Labor Department and the Securities and Exchange Commission to provide guidance to employers and plan administrators on including investments like private assets and 401k plans, the people said. The details of the order aren't yet final and are still subject to review, the people said. An order could help pave the way for big managers of private assets, such as Apollo Global Management and Blackstone, to access the vast sums of retirement savings held by workers who don't have a traditional pensions. Institutional investors, such as pension funds, have largely maxed out on private markets, leading firms to look to individual investors for exit liquidity. I meant for new sources of growth. I don't know why I said exit liquidity there. I don't know what I was thinking. In theory, retirement plan sponsors can already put some of their investments into private funds, and some already do in small quantities, but many companies remain concerned that they would be sued by their employees over the higher fees associated with private market investment products. Gee, I wonder why all these management firms are so eager to do it. Could it have something to do with those higher fees? Just maybe? I don't know. I'll just throw it out there. The industry argues that regular investors deserve the same access as institutional investors to the vast swaths of the economy in private hands. Then how come the industry wasn't arguing for this in 2021 when the industry was buying? How come they didn't want to democratize access when they were buyers? Now that they're sellers, they're like, oh yeah, everybody gets a seat at the table, especially when I'm trying to sell. Opening up 401ks won't necessarily level the playing field, said Ben Schifrin, director of securities policy at nonprofit Better Markets. One of my biggest worries is you're still going to have the institutional investors get the best offerings, and your retail investor is going to be left with the leftovers. That's putting it mildly, Mr. Schifrin. This is using mom and dad's 401k as exit liquidity. This is one of the swampiest things I've ever seen Trump do. Of course, second only to the whole Epstein thing, but I digress. Guys, know what's in your plan. I've been trying to warn people, sooner or later, these phone calls are going to start happening. Your guy is going to call you with this exciting opportunity of private assets. And, oh, yeah, it was just opened up and you finally have a chance to get in on the ground level. Nope, this is not ground level. The big institutions got in at the ground level. Now they want to sell and they can't find any other buyers. So they are looking at your 401k with a twinkle in their eye. Know what's in your fund, guys. Know what you own. All right, let's talk about PPI real quick. We'll blow through this one. It came in lower than expected. First is the year-over-year change in the producer price index. This is inflation being measured further upstream versus the CPI we got yesterday. Headline CPI or PPI came in 2.3% year over year. That is versus expectations of 2.5%. So lower than expected and down rather sharply from 2.7% last month. So producer price inflation continues to move down despite the headline risk from tariffs. That's kind of interesting. On a month-over-month basis, headline inflation was a whole bunch of nothing, 0.0% month-over-month. That's versus expectations of 0.2% and down from 0. They're saying 0.1. I guess we had a downwardly revised May number. Is that true? Not sure. Let me refresh this. I had 0.3 in my notes. There we go. It was an upwardly revised May number, hence the 0.3 that we had last month. Either way, it was a step change down for the month-over-month headline number. And then looking at core inflation, which strips out volatile food and energy, that came in at 2.6% year over year. That is also below expectations for 2.7% and down sharply from 3.2%, a big drop in core inflation, down 0.6% in just a month. And this is supposed to be when tariffs are hitting the producer prices. So I'm pretty surprised to see that one. And last but not least, core producer price index on a month-over-month basis, 0.0%. That is below 0.2% expected and down sharply from 0.4% last month. So PPI came in lower. It was way down from last month, lower than expected. This one kind of flies in the face of that CPI reading we got yesterday. It kind of makes you wonder, which one do you believe, the CPI or the PPI? Honestly, I don't know. They're both government statistics. I'm sure I'm going to get this in the comments, but when the government says something, you should automatically be at least a little skeptical. I'm highly skeptical of these numbers just because of what we saw yesterday. All right, now let's talk about what the banks did yesterday. This is in Barron's yesterday. Bank stocks are sliding after posting strong earnings. A lot of people were probably scratching their head because all the headlines said beat earnings and then the stocks were down. Well, bank stocks fell Tuesday morning despite strong earnings results from some of the nation's largest banks. Shares of JP Morgan Chase and Wells Fargo were down 0.73 and 4.77% respectively. Bank of New York Mellon stock fell 1.5%. All three companies reported better than expected second quarter earnings, but mixed results on net interest income may be weighing on financial stocks. Wells Fargo lowered its guidance for net interest income, a closely watched metric that measures the difference between what a bank earns on interest-bearing assets and what it pays in interest to customers. And I think it's that net interest income. We talked about that yesterday. That was the big driver of the sell-off in bank stocks. And I think it's possible what Coastal Journal was talking about on Twitter yesterday. It's that short-term borrowings may have been what was putting pressure on that net interest income over at Wells Fargo. Short-term borrowings tend to be more expensive. Those FHLB advances, repos, and possibly brokered deposits are the most expensive. It's usually something banks do when they need cash, possibly some early signs of liquidity stress. I just want to emphasize that it's possible and it's early. It's not indicative of any major stress developing in the banking system, but it's that decline in net interest income that was driving the sell-off in bank stocks yesterday. Now, we got more bank earnings this morning, and we're not seeing that with the banks we see this morning. Bank of America tops estimates as trading and loan revenue beat expectations. B of A's traders posted a record second quarter as the company reaped the benefits of volatile markets, and net interest income topped analyst estimates. Revenue from fixed income, currencies, and commodities trading jumped 19% to $3.25 billion for the 3 months through June. The company said in a statement on Wednesday that helped Bank of America top analyst estimates for per share earnings. Equity trading rose 9.6% to $2.25 billion. To 2.13 billion, also topping expectations. Volatility has whipsawed global markets since President Trump announced tariffs on trading partners around the world in April. That's been good news for the markets business at Bank of America and at its rivals across Wall Street, as they've benefited from a surge in client activity while also thwarting expectations for a strong rebound in mergers and acquisitions. The second largest U.S. bank also said that net interest income, a key source of revenue for the company, rose 7.1% to $14.7 billion. Analysts had expected a 6.5% increase for net interest income, the revenue collected from loan payments minus what depositors are paid. So whatever was happening in the banks yesterday because of that net interest income at Wells Fargo and to a lesser extent JPM, we're not seeing that with Bank of America this morning. Their results are pretty good across the board. Bank of America stock, let's make sure we have a current read here. It's basically unchanged here, 0.2% higher, up about 9 cents, $46.18. We also got bank earnings from Morgan Stanley topping estimates on increased trading revenue. We're going to see a lot of this here, guys. The investment banks are doing really well here because of that volatility. Morgan Stanley on Wednesday reported second quarter results that crushed Wall Street expectations on the back of higher trading revenues. Earnings per share, $2.13 versus $1.96 expected. Revenue, $16.79 billion versus $16.07 billion expected. Net income rose 13% to $3.5 billion, or $2.13 a share, from $3.1 billion, or $1.82 a share in the same period a year ago. Institutional securities reported net revenues of $7.64 billion compared to $6.98 billion a year ago. We've got wealth management was another strong segment for the bank, which delivered net revenues of $7.76 billion on higher asset management revenues. A year ago, that business saw $6.79 billion. The bank stock has risen more than 12% this year, doubling the S&P 500's performance. So Morgan Stanley, I guess what that last sentence is saying is a lot of this was priced in, as Morgan Stanley has outperformed the S&P by a huge margin. Perhaps that's why you got some profit taking going on this morning. Morgan Stanley stock is actually down 1.84% on stellar results. Those results were fantastic. But again, if you look at the year-to-date move in the stock, it's up 12.6%. So those results were already baked into the stock price. We've also got good numbers from Goldman Sachs with revenue and profits blowing past estimates. This one is in Investopedia this morning. Goldman Sachs on Wednesday reported second quarter revenue and profits that came in well above what analysts had anticipated. Goldman posted earnings per share of $10.91 on revenue that rose 15% year over year to $14.58 billion, blowing past analyst estimates compared by Visible Alpha. Net interest income surged 56% to $3.1 billion. That's above the $2.79 billion analyst consensus. I'll be honest with you, that net interest income surging 56%, that number's a little suspicious to me. That's almost too good. All right. When your net interest income, the difference between what you're making on loans versus what you're paying out on deposits, when it grows that much, to me, that says this bank is taking on a boatload of risk somewhere. That's the only reason I can see why they're earning so much more interest. So I would question that 56% surge in net interest income. In my opinion, that tells me they're moving out further on the limb, if you will. But Goldman Sachs shareholders were so far pretty happy with that. Stock up 0.86%, $707, and now basically $705, up a fraction of 1% for Goldman Sachs. But all the investment banks reporting pretty good numbers. Bank of America breaking the trend from yesterday of lower net interest income. Pretty good bank earnings this morning. Also going on this morning, ASML shares slump as tariff uncertainty prompts a growth warning. Statement from the Dutch chip-making equipment supplier comes days after Trump's 30% levy threat against the EU. Just want to emphasize that was a levy threat against the EU. Those tariffs don't go into effect yet. ASML Holdings shares slid after the Dutch supplier of chip-making equipment said it could no longer guarantee growth in 2026 amid increasing uncertainty from President Donald Trump's tariffs. The warning comes days after Trump sent a letter to the European Union threatening 30% tariffs on imports from the bloc beginning August 1st as trade talks between Brussels and Washington continue. The chip industry has been seeking clarity for months as the Trump administration conducts an investigation under Section 232 of the Trade Expansion Act of 1962, which could result in specific tariffs for semiconductors. ASML sells chip-making machinery to U.S. clients such as Intel. We continue to see increasing uncertainty driven by macroeconomic and geopolitical developments, CEO Chris Fouquet said. I don't know. Chris F. says, therefore, while we still prepare for growth in 2026, we cannot confirm it at this stage. ASML shares in Amsterdam fell more than 7% in morning trading. The stock is down more than 30% over the past 12 months. Mr. F's remarks come 3 months after he said that 2025 and 2026 would be growth years based on conversations ASML had with customers. Finance chief Roger Dassin said ASML was working with the supply chain to mitigate the impacts of tariffs as much as possible. So tariffs are taking a chunk out of ASML this morning. That stock down 7.25%. Trading, this is priced in U.S. dollars, $763.35, off by almost $60 here. And we've got Renault, is it Renault or Renault? We'll say Renault. I'm going to pronounce the T. Pardon my non-regional diction if I'm mispronouncing things this morning. But Renault shares dive after French automaker issues profit warning. Another profit warning in Europe. Renault shares fell 16% on Wednesday after the French automaker issued a profit warning that will lead to job cuts. They said late on Tuesday in an unscheduled release that they cut its margin guidance for the year to 6.5%. from more than 7%, and they cut their free cash flow estimate to between 1 billion and 1.5 billion euros, down from more than 2 billion euros. It said first half volumes were slightly lower than expected, but there's increasing pressure due to the continuing decline in the retail market, as well as the light commercial vehicle business. Inventories also have backed up, the automaker said. Renault said it will now prioritize value creation over volume and is planning the cost cuts to reduce selling, manufacturing, and research and development costs. And I can't help but grind my teeth here. They will prioritize value creation over volume. They're going to make fewer cars in order to make higher profit margins. That means they're going to make more expensive cars and sell fewer of them, which means the reasons that Renault is in such big trouble because they don't make affordable cars, they're going to do nothing about that. So sorry, you poor Europeans, your government wants you to give up your car one way or another. I'm sure riding a bicycle to work is really great, especially you guys with a 20-mile commute. You know, nothing like a little bit of cardio in the morning when it's raining. It's for your own good, though, you know, because climate. Renault absolutely getting clobbered. Look at this stock yesterday, 17.4% lower. This is Renault shares priced in euros, 34.06 euros yesterday. Destroyed on that news. And guys, this is not a tariff story. These guys do not sell cars into the U.S. market. This is just a global decline in the auto industry is what's going on here. It's got nothing to do with the orange man's tariffs. And the last one of the day, let's talk about this one. Westinghouse plans to build 10 large nuclear reactors in the U.S., interim CEO tells Trump. I'll believe it when I see it. I'd love to see it, but call me skeptical. Westinghouse plans to build 10 large nuclear reactors in the United States with construction to begin by 2030. Interim CEO Dan Sumner told President Donald Trump at a round table in Pittsburgh on Tuesday. That's funny. The guy's name is Sumner. Put a pin in that. Westinghouse's big AP1000 reactor generates enough electricity to power more than 750,000 homes, according to the company. Building 10 of these reactors would drive $75 billion of economic value across the U.S., and $6 billion in Pennsylvania, Sumner said. It's funny, $75 billion of economic value because it cost them about $15 billion per reactor for the last two that they built. The AP1000 reactors that they built at the Vogtle plant in Georgia cost $30 billion. They were only supposed to cost 10 or 12. And so if they're going to build 10 of them, they're going to be paying, based on those prices, about $150 billion to generate $75 billion of economic value. Yeah, that math don't really work for me, but I digress. The U.S. has built only 2 new nuclear reactors over the past 30 years. That's not entirely true. We also finished the reactors there was a reactor in Tennessee, Watts Bar, that finally came online. But we only started to completion 2 nuclear reactors in the last 30 years, both of which were Westinghouse AP1000s at Plant Vogtle in Waynesboro, Georgia. The project notoriously came in $18 billion over budget and 7 years behind schedule, contributing to the bankruptcy of Westinghouse. So they built 2 and it bankrupted them, and now they're saying they're going to build 10. The industry stalwart emerged from bankruptcy in 2018 in the U.S. and is now owned by Canadian uranium miner Cameco and Brookfield Asset Management. Westinghouse announced a partnership with Google on Tuesday to use AI tools to make the construction of AP1000s an efficient, repeatable process, according to the company. Okay, I see. So they originally said this reactor would cost $5 billion. It ended up costing 15, but now they're using Google's chatbot. And so that problem just magically disappears because AI. Don't worry, I'm going to go ahead and build 10 of these reactors when 2 of them destroyed my company a few years ago. Look, if you want to prove this to us, there's a perfectly good opportunity to prove this down in South Carolina. All right. It's called VC Summer. And that's why I was cracking up that the interim CEO's name is Sumner, because there's a plant that's almost practically named after the guy. The VC Summer reactors, they were trying to build 2 AP1000s at that plant to go along with the 2 they built in Georgia. But after spending more than $10 billion and only getting about 40% complete, they abandoned that project. So there are 2 nearly halfway complete AP1000 reactors sitting idle in South Carolina right now. If you claim you can build 10 and you can save all this money because of Google's chatbot, then go finish those. Because the ratepayers in South Carolina, every electric bill in South Carolina right now has a little line item on it, a little charge that they pay in order to pay for the cost of Westinghouse's failed project in South Carolina. So, look, I would love to see these reactors get built. I would prefer we build small modular reactors. I think that is the more promising technology, but I think nuclear is far better than any of the other alternatives that are out there. But I can't help but be skeptical because empirical data says these guys are full of it. And just because AI doesn't make a $12 billion per reactor cost overrun just disappear overnight. It just doesn't work that way. Your chatbot is neat, but it is not that good. And I just want to say thank you very much to Raiden, the God of Thunder, says no solid gold for retirement funds ever. Look, guys, there are ways to invest in gold in retirement funds. All I got to tell you is be careful. There are so many snake oil salesmen in the gold IRA business. A lot of times these guys, they are sleazy salesmen, and they will steer you. If you're not careful, they will steer you into this high premium garbage. That's if they don't steer you into something like First State Depository in Pennsylvania, where they just outright steal your gold, and then you're stuck trying to get some of your nest egg back from a bankruptcy court. Just be careful in that. And as always, be careful with that, and be careful with this private asset crap that President Trump is trying to enable. Honestly, I mean, look, if I had it to do all over again, I'd still vote for the guy because I hate communism, and I think the alternative was communism. So, I mean, I'm not going to go there. I just wish he wasn't proving to be so full of it. And I'm shaking my head. I can't believe what he's doing with this democratization of access thing. It is so obviously a bag holder bailout at the expense of working people. And I see the whole finance industry falling in line. The press is asleep at the wheel. The financial press is not doing its job to warn people about what this is. Maybe now that President Trump is doing it, they'll sing a different tune. I don't know. Maybe Mr. Orange being on that side will make the press be like, okay, now we can tell the truth about this subject. Sure. But then again, all the people who advertise in the financial press, they're the ones that are trying to sell this crap. So maybe not. Just be careful, guys. Thank you very much, Raiden, for supporting the channel. And Raiden is back again. He says there is the one in Toronto set to produce power in 5 years. Whatever the reactor is in Toronto, it's not an AP1000. The Canadian reactors are very different than the U.S. reactors. I don't know much about them, to be honest with you. I'm guessing some modernized version of the CANDU reactors, what they're trying to build in Toronto. Set to produce power in 5 years. Wish them luck with that. Again, the nuclear business has been very bad with the deadlines these last couple of years, notorious for cost overruns and project delays. Those reactors we built in the States were years behind schedule, as well as billions over budget. But I wish them luck up there in Arctic Mexico, if you will. Thank you very much, Raiden, for supporting the channel again. Chris Bott says, self-direct your 401k. I am in a self-directed IRA, so it's possible. The one that I'm using, it's risky. Let's just put it that way. There is no risk-free place to put your 401k. Everything has some element of risk. The best I can tell you guys is do a lot of reading, do a lot of research, read the pros and the cons, and do your best to mitigate that risk based on your unique situation. There's pros and cons to along with that, guys. Unfortunately, they lock up your money with 401ks. You don't have access to it. And then they limit your options, and the options aren't particularly good. So thank you very much, Chris. That is good advice, sir. Appreciate you for supporting the channel. Robert feeds the machine. What's going on, Robert? He says, no matter how bad things may seem at the moment, just remember it can always get worse. Yes, it can. It is the 2020s, and there are 4.5 years of this decade left. So let's not act like we've bottomed out yet. Is that an optimistic appraisal of this? I don't know. Let me know in the comments. Is Robert being an optimist or a pessimist here? Because, he's suggesting, hey, things could be worse, which would suggest things maybe aren't that bad. So that's a little optimistic, but they could get worse. That sounds like pessimism to me. I don't know. We tend to be a little on the negative side on this channel, right? I get that. I wear it on my sleeve there. Perma Bear in invisible ink. But yeah, things always can get worse. Thank you, Robert. Appreciate that, sir. Always stop and smell the roses, folks. Pigo's Trading Desk says, morning, handsome. Hey, good morning yourself. He says, we discussed this. Poor Grammy. Yeah, I agree. Look, guys, that is the ultimate bag holder is retirement plans, pension funds, and 401ks. All right, whenever they're trying to democratize access or expand access or give people more choice, they never talk about giving people more choice during the good times when things are going up, right? These private assets that they're trying to loan to put in people's 401ks, they're not putting them there because the values of these things are going up. All right, the values of these things are just barely going sideways because the industry is jumping through a million different hoops to try to prevent price discovery. They're playing this giant game of the floor is price discovery. They're doing it with commercial real estate too. So yeah, when they're trying to dump this stuff into retirements, it usually means it's that the game is almost over and they're running out of time. Quick, park this crap in grandma's pension or grandma's 401k because the government will bail her out without a question. This absolutely is a taxpayer bailout of the private equity and private credit industry that they're trying to push here. Because by putting this stuff into 401ks, the taxpayers will definitely bail out the 401ks. And so if the reason the 401ks need the bailout is because they bailed out the private equity and private credit industry, well then who are the taxpayers really bailing out? Wall Street. Thank you, Pigo, for supporting the channel. And Tom Dillon says, this market is insane. I'm out. If 10x earnings is what were you thinking, what is NVIDIA at 55? Not mania, insanity, gold for the win. Look, Jensen is in China right now praising DeepSeek, praising all the Chinese innovation. Even after a week ago, he's in the press saying the United States must maintain its edge. If we want to defeat China, we need to let my company sell chips to China. Jensen Huang is a lying sack of excrement. Let's just put it that way. I'll be honest with you. The guy deserves to be infamous. Right now, he's still signing boobs and everybody's still like fawning over him when he appears at conferences. Honestly, by the end of this decade, he will be the next Sam Bankman-Fried or the next Bernie Madoff. I swear. What he's doing is so unbelievably treasonous and sleazy. Everybody can see him doing it, and everybody is giving him a free pass because they're making money off of it. It is a case study in just how awful human beings are capable of being to each other. Thank you very much, Tom Dillon, for supporting the channel. Sir, Robbie Gray says, do you think Jay Powell will be fired soon? No, I don't. I don't think he'll be fired. I think right now they're trying everything they can to get him to quit. They're trying to wait as long as they can to avoid a shadow chair, which is where, like, President Trump would basically say, the next Fed chair is this guy. And then all of a sudden the press starts wondering, what is this guy going to do? And they start interviewing him and everybody listens when he talks. And that, by default, takes some of the power away from Jay Powell, away from his ability to move markets, because markets are always more forward-looking. They want to know what's going to happen next year, not what's going to happen tomorrow or today. So I think the appointment of a shadow chair is more likely. Maybe Powell resigns, maybe not. I don't think they're going to fire him, though, especially after that Supreme Court decision that basically said he can't fire Powell. So I don't think that's going to happen, Robbie. And nor should it, by the way. I think Powell is doing the right thing right now by not cutting rates. I think he's doing it for the wrong reason, politics, but I don't think we need rate cuts. The money supply is still growing. These are not tight financial conditions. Financial conditions are loose as all get out. Money supply has grown by $1.5 trillion in the last year and a half. That doesn't happen under a restrictive environment. Thank you, Robbie, for supporting the channel. Thank you, my man, Mish the Mod, for gifting 10 Nobody Special Finance memberships. Thank you, Mish, for doing that. Hey, guys, if you received one of those memberships, be sure and say thank you to Mish. That was very nice of him. And just a reminder, if you get one of those memberships, you get one free Super Chat a month. Feel free to use that, and I will read and respond to your question on the air, as I shall now do with Welco Services, who says he will read anything if you put it in the teleprompter. Bacon. I'm Ron Burgundy. Who put that question mark in there? That's right, Dance Monkey Dance. He will read anything if you put it on the teleprompter. Most anything. Every now and then, something gets put in there that I won't read, but sometimes it gets by me. Thank you, Welco, for the laugh, sir. Living Our Destiny says, hit the like button, Melonheads. I'm Jack Gamble, and I approve this message. Hit that like button for the algorithm. Thank you, Living Our Destiny, for supporting the channel. Madison Hype's been a Melonhead for 9 months. That's Proud Melon as well. Sounds like a Creedence song. Proud Melon, right? Why not? Sure. Left a good job in the city to do YouTube. All right. Thank you, Madison, for supporting the channel. Pigo is back for one more before the sign off. He says Martin Armstrong put out a warning. NATO 250,000. Uh-oh, did we hit the enter soon too early there? It looks like you're saying 250,000 troops, maybe? I don't know what that TR means there, Pigo. Sorry, brother. Let's see. Yep, 250,000 troops. 250,000 troops. What are they mobilizing? Are they? Look, NATO's beating the war drums, guys. I mean, we're now like openly supplying the Ukrainians. President Trump has now said, yeah, we'll give all the weapons in the world to Ukraine as long as the Europeans pay for them, which the Europeans are doing. So much for all that, infrastructure spending and everything. The Europeans got rid of their debt breaks, and where's all that money going? To American defense contractors of all places. And then M and J's in the chat say Middle East is popping off again too. Yeah, I just heard about that one this morning. Haven't had any time to read in on that. I'm sure that will speed us on our way to excellence. Just a reminder, guys, the war drums are still beating around the world. Thank you, Pigo, for supporting the channel, guys. And thank you, everybody, for having your coffee with the Melon Heads this morning. Don't forget that like button and that subscribe button on the way out, should you feel so inclined. Thank you, guys, so much for all the super chats and the support of the channel, as well as you, my magnanimous Melon Heads on Patreon and YouTube. You guys are the best. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.